Right now, something unusual is happening in the silver market, and most people have no idea what it means. Silver prices are showing two very different numbers at the same time. In the paper market, silver is trading around $83. But in Shanghai, physical silver has touched nearly $95. That kind of gap almost never lasts long. When a difference like this appears, something usually breaks. And according to several analysts, the clock may already be ticking. Some believe there could be only a few weeks left before the market is forced to react. Today, we're going to explain what's really going on, why a massive $1.3 billion move by Jane Street is raising questions, and why this strange price split could matter much more than most investors realize. Before we go deeper, if you enjoy simple explanations about gold, silver, and protecting your wealth during uncertain times, make sure you subscribe to Safe Haven Wealth and leave a like on this video. It really helps the channel grow and allows us to keep bringing you clear insights about the financial world. Now, let's slow down and understand the situation step by step. Most people think there is only one price for silver. When they search online, they see a number and assume that's the real value everywhere. But the truth is more complicated. There are actually two major worlds in the silver market. One is the paper market, where contracts are traded on exchanges, like futures markets. The other is the physical market, where real metal changes hands between buyers and sellers. Usually, those two markets stay closely connected, with prices moving together, but sometimes the connection begins to stretch. Right now, that stretch is getting wider. In the Western paper market, silver has been trading near $83. But on the Shanghai exchange, where physical demand from Asia is extremely strong, prices have moved close to $95. That is a massive difference for the same metal. It suggests that physical silver might be more valuable than what the paper market is currently pricing. So why would this happen? The answer often comes down to supply and demand. In recent months, global demand for physical silver has been rising. Industrial use continues to grow, especially from solar panels, electronics, and new energy technologies. At the same time, investors in many parts of the world are buying physical metals as a form of protection against inflation and economic uncertainty. When physical demand increases faster than available supply, prices in certain regions can start moving higher. That appears to be happening in Shanghai. Asian buyers have been aggressively purchasing real silver bars, and that pressure is pushing the physical price upward. Meanwhile, the paper market can behave very differently. Futures trading allows large financial players to buy and sell huge volumes of silver contracts without actually moving physical metal. Because of this, paper prices sometimes move based on speculation, hedging strategies, or short-term trading, rather than physical supply conditions. Normally, the system balances itself. If physical prices rise too far above paper prices, traders step in. buying from the cheaper market and selling into the expensive one. This process is called arbitrage, and it usually closes the gap quickly. But when the gap stays wide for longer than expected, it raises a serious question. Is the paper price truly reflecting reality? This is where things become even more interesting. Reports have surfaced that Jane Street, a large global trading firm known for sophisticated strategies, made a move involving roughly $1.3 billion connected to the silver market. That kind of capital deployment does not happen randomly. Firms like this run extremely advanced models before placing large bets. When big institutions suddenly step into a market with that level of money, other traders start paying attention. It suggests they see something developing beneath the surface. Some analysts believe this move may be connected to the widening gap between paper and physical prices. If a firm believes that physical silver will continue to trade higher than the paper market suggests, there are ways to position for that outcome. These strategies can involve futures contracts, arbitrage trades, or acquiring physical supply before shortages appear. While we do not know the exact strategy behind the Jane Street move, the size alone indicates that serious money is watching it. Another factor fueling the conversation is the idea of a timeline. Some analysts studying exchange inventories, delivery schedules, and open contracts believe that the current imbalance could reach a critical point within a few weeks. The number often mentioned is 24 days. Now, this is not a guaranteed countdown, but it represents a period where certain contracts and delivery obligations may collide with physical supply realities. If too many traders request delivery of actual metal at the same time, the exchange system can experience stress. This has happened before in different commodity markets. In most cases, exchanges find ways to settle contracts with cash or roll them forward. But when physical demand keeps rising, the pressure can grow stronger. Think of it like a warehouse that promises to deliver a certain number of boxes. As long as only a few customers ask for their boxes at once, everything runs smoothly. But if suddenly many customers show up demanding their boxes, at the same time, the warehouse has to prove it really has the inventory. In the silver market, inventories have been closely watched for years. Some experts believe there is plenty of metal available, while others argue that the supply cushion is thinner than people think. The current price difference between paper markets and Shanghai physical markets is one signal that the balance might be tightening. Another important piece of the puzzle is global money flow. In times of economic uncertainty, investors often move toward assets they believe hold value. Over long periods, gold has traditionally played that role, but silver sometimes moves even faster during strong demand cycles, because the market is smaller and more sensitive to changes in supply. If physical silver continues trading at a premium in major international markets, traders may begin shifting strategies. More contracts could move toward delivery. More investors may want real bars instead of paper exposure, and the paper price could be forced to catch up. However, it is also possible that the gap closes in the opposite direction. If physical demand cools down or new supply enters the market, the Shanghai premium could shrink and prices may reconnect naturally. Markets are complex systems, and outcomes are never guaranteed. What makes the current moment fascinating is that multiple signals are appearing at the same time. A large price gap between markets, rising industrial demand, institutional money entering the trade, and a potential timeline connected to contract deliveries. When several unusual signals appear together, experienced investors begin paying closer attention. For everyday viewers, the key takeaway is not panic or excitement. It is awareness. Markets often move quietly before major changes happen. By the time headlines appear everywhere, the biggest opportunities or risks may already have passed. That is why channels like Safe Haven Wealth focus on explaining these developments early and clearly. Our goal is not to predict the future with certainty, but to help you understand the signals that professionals are watching, so you can think about your own financial decisions with more clarity. And this is also why discussions around physical versus paper markets are becoming more common. Many investors are asking deeper questions about how commodities are priced, how delivery systems work, and whether market structures built decades ago still reflect today's global demand. As we move forward through the next few weeks, analysts will continue watching inventory levels, delivery requests, and the behavior of major trading firms. If the price gap between $83 and $95 begins closing rapidly, that will tell us something important. And if the gap widens even more, it could signal that the physical market is sending a message the paper market cannot ignore. Either way, the silver market is entering a period that many experts believe could be historically significant. Whether that leads to a sharp breakout, a quiet adjustment, or something in between remains to be seen. But one thing is certain: the world is paying attention again to a metal that has played a financial role for thousands of years. If you made it this far in the video, I'd really like to hear your thoughts. Do you think the paper price will catch up to the physical market? Or do you believe the gap will close the other way? Share your opinion in the comments, because discussions like this help everyone understand the market better. And if you found this explanation useful, consider sharing the video with a friend who follows gold or silver investing. It helps more people discover safe haven wealth and keeps the conversation growing. Thanks for watching, and we'll see you in the next video.